Hello, everybody, and thanks for joining us today. I think we'll try and get through this pretty quickly. I imagine that we won't take much more than about 20 minutes going through the details ourselves. But just to kick off, perhaps it's worth mentioning the genesis of where the idea came from. And I think it's worth pointing out that this idea came as part of our process looking at a company that we own for the Collins Street Valley Fund, that being Mermaid Marine. And in our research, we discovered there was this whole subsector that looks incredibly attractive. But unfortunately, because the stocks that fill that sector are not listed in Australia, it unfortunately didn't quite fit the mandate of Collins Street Valley Fund, which is why we looked to invest not through CSVF. Now, initially, Vas and I talked about just doing it ourselves because it wasn't available for the fund. But in some casual conversations we had with some of our ongoing relationships and our ongoing investor base, we got the sense that there was some keen interest in this idea, and so we decided to, instead of doing it personally, we decided to launch it as a fund, and that brings us to where we are today. I think it's worth noting that the reason that we are quite excited about this idea is because of the asymmetric nature of the risk versus the upside potential. Primarily, we think that that's being driven by the market considering social norms and social expectations rather than really focusing on the financial calculations of what's on the table here in investing in these sorts of companies. As we go through, if you have any questions, please send them to my email. That's mgoldberg@csvf.com.au, and we'll come to those questions at the end of the conversation. Now, from here on, I'm going to handball it over to Vas, who will run you through the tailwinds for this idea and also give you some additional color on how we imagine this is going to play out and the sorts of companies that we're investing in. Again, if you have any questions, please email me at mgoldberg@csvf.com.au, and we will get to your questions at the end of this conversation. Vas, over to you.
Thanks, Michael. Thank you, everyone, for attending today's session. So I'd like to start on a high level, and then we can move into the more detailed discussions around the actual opportunity. So I guess as value investors, Michael and I look at anything and everything. However, everything needs to be based on fundamental analysis, and we need to arrive at a intrinsic valuation of the company, whether it's from an earnings perspective or an asset perspective. So I think that's very important to mention. Second to that, I just want to reiterate to what Michael said. If we could have found a basket of offshore oil services companies listed on the ASX, we would have just bought the fund. Unfortunately, this is one of the few industries where, apart from the one company we bought, there is no other way to play this sector in a material way on the ASX. And so the typical basket we're talking about is the global offshore oil services sector. Now, why offshore oil services? Well, what we can tell you is that the offshore oil services sector, so that is companies that service the offshore producers, that industry actually entered a downturn in late 2014, early 2015. Now, like a typical commodity downturn, it was brutal near the bottom. A lot of companies entered Chapter 11 bankruptcy and have subsequently exited. There have been quite a few mergers in the industry, and we actually started to see some green shoots to that sector in late 2019. The unfortunate thing was, obviously, COVID came, and we believe that COVID has pushed back the turnaround in that sector by roughly 12 months. And now the typical businesses we're talking about, just so everyone's clear, are companies that obviously service the big oil producers on a global scale offshore. Now, the type of assets they have is they either own the big drill ships, they either own the exploration ships, they either have assets that service the crew. So for example, one of the companies we're looking at owns a fleet of roughly 270 helicopters that is used to transport the offshore crew around the rigs. We're also looking at companies that lay the undersea pipelines and the connectors for these rigs. And so we're talking about companies that are listed on the North American stock market, so the USA, Canada, England, and a few in the Scandinavian countries, predominantly Norway. And so the largest market cap out of the target market is roughly 4 billion. The smallest is 500 million. They are relatively liquid. These businesses, why we get quite excited about from a value play is, as I said previously, the companies we are targeting actually have very strong balance sheets. They have either previously exited Chapter 11 bankruptcy and have come out and have recapitalized their balance sheets. They have either merged already. And so we are talking about businesses that have very strong balance sheets, in some instances net cash, and they are trading at roughly 15 to 20% of the replacement costs of their assets. And one of the cheapest companies that is over $1 billion market cap is trading about 3 to 3.5 times its annual cash flows. And so you're talking about businesses that are on a historical basis very, very, very cheap. On a fundamental basis, very, very cheap. And I guess a lot of the uncertainty in the short term, let's call it, around anything related to oil is, what will the oil demand look like in the years ahead? Now, there are numerous, I guess, opinions out there to when oil will peak and when will it start to fall. Now, based on our analysis and on looking at credible economists and research houses, we are relatively comfortable in stating that oil demand is unlikely to peak until at least 2030. Potentially it could be pushed out to 2040. But the reality is, from now till 2030, it looks like oil demand will be going up. And so with respect to this investment, whose time horizon is 3 years or less, so this fund, we're looking at exiting these stocks 3 years or less is the typical time frame we're looking at. And so if you delve deep into why this opportunity has come about, it is multifaceted. So the first point I would like to point out is a lot of these ESG considerations, a lot of shareholders and fund managers have been selling stocks, not just in the offshore oil services sector, but anything related to fossil fuels. There has been some heavy selling over the last 6 months. The good news about that is, especially from the offshore oil services sector, is a lot of that selling has finished, it has been done, the damage has been done. And so we think there is minimal impact on the shares from potential ESG selling at the moment. In fact, the companies we are targeting, the share registers are now new private equity fund managers or value funds such as ourselves. Now, the second interesting point to this, I guess, discussion is offshore oil in general. So really, apart from the, I guess, the region in the Gulf, so the onshore Gulf region, which is predominantly OPEC related, most of the production growth in oil over the last decade has actually come from the US shale industry. Now, the US shale industry is pretty interesting, it's pretty intricate, and the moral of the story is shale demand has peaked, and it looks like it will never surpass its previous high. So a US shale oil well roughly depletes 70% per annum. Now, that is a pretty inefficient type of economics. So every 12 months, an oil field in the US shale region depletes 70%. So the US shale drillers need to constantly drill their wells to keep their heads above the water. Now, that industry was in a heyday, roughly half a decade ago. Wall Street was loving US shale drillers. And so there came a point now, which we believe after a decade of strong shale drilling, that a lot of the tier 1 deposits in the US shale region have been depleted. And now the US shale drillers are looking at the tier 2 and tier 3 deposits, which are not as efficient and less profitable than the tier 1. So that's one of the reasons to why we think the US shale industry has had its heyday and that it will not be producing like it used to. So hence the effect of that should mean some relatively strong oil prices over the medium term. The second more important point to this investment thematic is Michael and I always work backwards. So we like to hone in on company specific stocks that are cheap, or alternatively industries that smack value to us. And, you know, if these companies we're targeting, if they trade at 50%, so half their replacement costs, which to be honest, on a historical basis is very cheap. I mean, during upticks in the cycle, these companies normally trade at 2 times their replacement costs or 2 times their net tangible assets. But Michael is saying, no, forget 2 times. If they trade at 0.5 or 50% of their replacement costs, on average, we expect the stocks within this portfolio to roughly go up 2.5 to 3 times. And so we think over a 3-year time horizon or less, we think a 2.5 to 3 times upside produces some pretty strong annualized compound returns. And so I guess this fund, we have set it up. It's a simple unit trust structure, such as Collins Street Value Fund. Michael and I and our respective families have put our own capital on the line. The fee structure is almost identical to the Collins Street Value Fund, where we charge 0 flat fees and we will only have performance fees. However, the performance fees we're only going to charge at the end once the fund is wound up. So an investor that invests in this fund, the money is locked in until we close and basically close the fund and return proceeds to shareholders, or unit holders, I should say. We envisage the time frame to be 3 years. We think it's might be less than 3 years, but we've allowed ourselves 3 years. But the full details of the duration is in the IM. So if anyone would like to know more about the details, just read the IM, or alternatively send Michael a question to his email, and we can try to answer that at the end of this call. The risk to this investment, we're relatively comfortable with the risks, and we say that because number one, we always hone in on capital preservation. So Michael and I would rather miss an opportunity, even if it's a potential 2 to 3 or 4 times your money, if there is significant downside. Now, because these businesses have recapitalized their balance sheets, because they've already entered Chapter 11 bankruptcy and have come out, because they are merging, in fact, the first and second business that we are interested in and have already started to buy shares in, we've heard off the grapevine, so we haven't heard from management, but from industry participants, that they're looking to merge. So we think a lot of the companies we're targeting are going to merge within themselves, which is pretty good for the sector because it gives them further pricing power. It consolidates an already consolidated industry, and the cash flows these guys will be spitting off should be significant. And because the share registry of these companies are private equity funds and value funds such as ourselves, having spoken to management and having spoken to a lot of the large shareholders, we are confident that the cash flows these companies will produce will either go into large dividends or large share buybacks. Either of those alternatives should produce some pretty strong returns if you look at the current share prices. Now, this fund, we will be closing the application in by the 31st of August. So really, there's only 11 days to get the application form signed, filled out, and scanned and sent back to us, and money transferred into the applications account. We have issued our first units, which was the start of this month. So obviously the start of next month will be the second and last issue of units. We haven't marketed this fund wide. It's pretty much, we've just targeted our existing investor base and that's it. So Michael and I never had a actual target per se, but it has surpassed our expectations, and happy to say it looks like we're going to be just above 20 million for this fund. And I guess, you know, we are very excited to have found another sector that we feel is cheap. you know, Michael and I are pretty patient when it comes to buying companies or sectors that are out of favour. We always wait before we see catalysts, and we have seen catalysts within the sectors that we're looking at over the last 3 months. We've seen their margins go up, we've seen their day rates go up, we've seen their utilisation go up, and so we've waited, and we're seeing the green shoots, and that is the time when you pounce on an industry that is unloved. You wait to see the green shoots, and we're seeing them. So I guess that's pretty much what we would like to talk about today. I think Michael and I will have a 2 to 3 minute break. We will, if anyone has any questions, please email mgoldberg@csvf.com.au. Within 2 to 3 minutes, we'll come back online to answer any questions anyone has. And I do thank you all for attending today's live conference.
Thanks for your patience, everybody. It looks like we've covered off on just about all of the questions that were sent throughout the conference call. The one that I'm not sure that we covered, and Vas, I'll handball it across to you in a second, is the disruption from electric vehicles coming on board and how that would impact demand for oil. Before I handball just to Vas to answer that question, I thought it was just worth reiterating that really the 2 key points that get us really excited about this particular idea is, number one, the disruption that's happening to the oil cycle. Ordinarily, when you see a cycle go up and down, prices tend to go up, competition comes on board, and then of course prices go down, competition goes away. In the current environment where ESG is driving so many decisions, especially financing decisions from a lot of banks, it's incredibly difficult for a new project to come on board. So we wonder, and we're quite keen to see how it plays out, certainly over the next 10, 15 years, although that's beyond our scope for this, but it will be interesting to watch how the cycle will play out when there's no additional competition coming on board. Now, we're not investing for that. The reasons that we're investing is because these underlying companies are inherently cheap, both on a cash flows basis, where they're trading at about 3, 4, 5 times cash flows, which is exceptionally cheap. And as Vas pointed out, we expect a lot of those cash flows to come out by way of dividends or buybacks, but also because a lot of these companies, as Vas also pointed out, are trading at less than 30% of the value of their assets. So if we get back to any sort of historical norm, we would expect to see significant returns from these companies. Vas, over to you on the electric vehicle question.
So with respect to electric vehicles, obviously there's been a lot of commentary in the media and in the, I guess, around analysts and economists, but the reality is passenger vehicles generally is roughly 15% of the demand of oil. The balance comes from industrial production and manufacturing, such as plastics, and also aviation, which is aviation actually represents 15%, the same as passenger vehicle demand, and also non-passenger transportation, so trucks. Now, I don't think there are many batteries that are powerful enough to run trucks yet. They may be in the future, but they'll be certainly quite expensive. And so, if you weigh everything up, even if tomorrow everyone went out and bought a Tesla, we still think the offshore oil services sector and oil demand will still be strong. So yeah, I guess the commentary around EVs is slightly overblown over the short to medium term. Yes, in a few decades it will affect it, but again, in the short to medium term, passenger vehicles is only 15% of demand. And so, you know, you can have a scenario where even if everyone had Tesla cars or, you know, an EV, the mathematics of this is if production falls greater than the demand fall. So if demand falls 15%, yet production of oil falls greater than 15%, which, you know, may happen in the future, then the oil price may still be quite strong, in fact, higher than where it is currently. And so, you know, there is going to be a twilight period at the moment where we believe we're going to see, because of rational decisions made by oil producers and oil service providers, that the cash flows they're going to be making is going to be relatively significant. Another question that just came through is why are you so confident that margins to these companies are going to be strong? So just to reiterate what I said before, so these companies we're talking about are globally significant companies. They're not small companies. The smallest is 500 US million, the largest is 4 billion. Now these companies have real earnings and cash flows. They have huge asset base, billions of dollars worth of assets, and basically, you know, we are seeing their margins increase over the last quarter. Their day rates are going up, and we are hearing further signs of consolidation within the sector. There's already been 4 mergers within the sector, and we think there's going to be more mergers. And it's interesting that the mergers are not just happening in the service providers, it's also happening with the producers. And you're seeing the likes of Santos and Oil Search, Woodside and BHP Petroleum merge. So I think we're going to see a lot more mergers in the producers and the service providers, which will be a net benefit to those companies that merge. And ultimately, like all businesses, you need to value them based on their cash flows. And based on the cash flows we think these service providers are going to produce, we are pretty confident, without guaranteeing it, but we're pretty confident that there's some good risk-adjusted returns to be made in this sector. So that's it for me.
Thanks, Vas. I think we've covered off on all the questions. There were 1 or 2 that came through that ask specific things about specific investors, so we'll give you a call shortly. Again, thanks for joining us, and if you have any additional questions, feel free to give us a call or send us an email, and we'll be in touch as soon as we can. Thanks, everybody.